Hello, welcome back. In this premium video, we are going to talk about backtesting, pattern failure statistics, and the advanced playbook for you to take the trades. So, what is backtesting and why is it important? Now, right now, suppose we are looking at this particular pattern, whatever the pattern it is. So, suppose this pattern says market goes up and market goes down, very simplistically. So, suppose there is some cut in the market, this pattern somewhere will repeat. So, can we say that this pattern always works? We cannot say that because none of the patterns always work. Let me just give you another example and let's use EMA. Let me show you how do we do it. So suppose we are talking about Reliance chart. So this is the Reliance chart. Let's go somewhere back. So let's see this chart. What do we want to do? We want to do a back testing. And what is back testing? Simply, let's identify some kind of pattern. So one pattern can be that when stock price moves above this moving average. So what is this? This is a moving average. So this is a 20-day moving average. So suppose if stock price moves above this moving average, then I should buy. So now this is the hypothesis which right now I am thinking of. So I see here could be the opportunity when price moves above this, I will buy. Now, are you sure that this kind of understanding is right or not? You want to evaluate that. Then what you will do? In the past, you will go, right? So there are two ways of doing the back testing. One of the ways is that you have lots of data in the Excel sheet. You have daily data in the Excel sheet and then you calculate your EMAs, etc. In the Excel sheet and through a software. And for your back testing, generally what will happen? You will have to define the program based on which you will be doing the back testing. But that is a tedious way. If you want a simplistic approach, I can provide you that for the back testing. So now what I am going to tell you is a very basic simplistic approach through which you can do a back testing and back testing for any of the strategies. So now let's see this chart which is for HCL Tech. Let's do a back testing. But before back testing, we have to identify a situation. Let's assume this is only 20 EMA and what we are saying, once the price closes about 20 EMA, we should buy, and when the price closes below this EMA, we should sell. A simple approach for the back testing. So what we will do, we will look at this graph and we will identify the points where it has done that crossover. So here the crossover is there. Price has crossed this black line which is 20 EMA. And after that you can see, you can record in a Excel that okay, this much is the profit percentage which we have got. So you can see here is the 19% up move which we can see. After that price has gone below 20 EMA and after that you can see how much you can see the downturn. Market has gone for 21% downturn and again when it has moved up, now it is time to take a buy possibly. So similarly what you will do, this is the future one, so you remove that, you talk about the previous one. So one here, so this is doing a correct thing. Here you can see, so here it has performed well, here it has performed badly because market has gone down but it has not crashed actually, so because it has turned away. So that would mean that your back testing failed here, but here back testing again is correct. Here back testing is correct. Here back testing is wrong. And here back testing is correct. Here back testing is correct. Here back testing is wrong because market has moved up but suddenly it has fallen. So what you need to do, you have to mark all of these points and go for a year back. So at least 1 year data you can say. So you can, maybe it will hardly take 1 hour or maybe 1.5 hours. You take that kind of data for this stock and after that you will identify what is the percentage of times when your thesis was correct. So when I say thesis was correct, that means your thesis was that when price is above 20 EMA you will buy. So how many percentage of times? So suppose in last 1 year what happened, that 80% of the times it happened that when market has crossed 20 EMA, then stock has moved up maybe 10-20%. 80 times it has happened and 40 times it has happened that it did not cross. So that means out of 120, 80 is the success rate, right? Are you in the stock markets but still guessing your next move? I am from Uncover Markets and we are bringing a complete solution for your stock market needs. Whether your portfolio is of 1 to 2 lakhs or 50 crore, we show you practical ways to enhance returns and protect your capital. You can take short, quick learnings you apply on the same day, or let us handhold you through long-term programs like Elliott Waves and advanced derivatives to secure your portfolio and generate alpha. And if you enjoy fast-paced option buyings, we have got you covered there too. So join Uncover Markets and rise in the markets. Thank you. So that would mean that 66% of the times your strategy is successful. So that is simplistically the backtesting. Without backtesting, you should never take any trade. So this is a very simplistic scenario, and this is real scenario also. Many people use this particular strategy. They just take the trade when we are above 20 EMA and they exit when we are below 20 EMA. So this strategy works a lot of times. Secondly, what you can do, you can combine the strategy for the backtesting. So what you can do, you may combine 20 EMA along with 200 EMA also. So you will say that you will take the trade when the price is above 20 EMA chart and when price is also above 200 EMA chart. And you may sell, you may think that it will be good to sell when price is below 200 EMA chart and it is also below 20 EMA chart. So what will happen if you combine few conditions, then number of times you have to take trade will reduce. So in the first situation, when I was just taking the trade based on price crossing 20 EMA. At that point of time, suppose there were 120 trades for 1 year. It was happening, right? For 1 year, it was happening. There were 120 trades which you would have taken. Suppose you combine two conditions. So one is 20 EMA and additionally 200 EMA. Or you may combine volume also. So you may combine volume, you may combine MACD, etc. We will see in the next videos how to do that. So if you combine 2 or 3 indicators, then your number of triggers when you should buy or sell will reduce drastically. So on an average, if you are getting 120 trade opportunities in a year, then for that particular stock, if you combine 2 or 3 kind of indicators, then the number of trading opportunities will reduce to maybe 40, maybe 30. And this is actually a good thing because less number of trading will ensure that you pay less on brokerage, and secondly, you will get more comfortable signals, whether it is for the buying or whether it is for the selling. So that's how the backtesting works. Now the pattern failure statistics. So suppose you have set up one kind of setup that we have earlier talked about, that there is a resistance zone, then after that if there is a bullish candle, then only I will buy the stock. So you can do a back testing. You can create all the resistance and all the support lines for last 1 year and see how many times market has tried to overpower or overcome these resistance or support zones. And after that, what has market done? Has it actually moved up as expected or market just crashed? So these are the data driven analysis. If you want to be a good trader or successful trader, you must do that. Without that, you must not take the trade. So then what will happen? There are certain kind of stocks which are very less volatile. There are many stocks which are more volatile. So more volatile stocks will have lots of signals and more number of opportunities will be provided to you for the trade. The stocks which are less volatile, which are kind of settled, they don't move really quick up or down. They will provide less number of opportunities, but those are a must have in the portfolio to provide you stability in the portfolio. So what you need to do, two things we have discussed. One is the back testing and second, the failure statistics. So suppose we were discussing about this one. You identify whether a bullish candle goes up, then market goes up or no. So you identify for last 1 year, 2 year and identify how many times it has happened that market performed positively or as expected after crossing it, and how many times after crossing it, it has gone down. And then once you see how many times it has gone wrong, then see why it has gone wrong. Then you may look at the volume chart like we have discussed in previous videos. You can see there. So you can combine this with the volume chart. You can see if it is failing. So was volume as expected? Because volume should have risen here. So suppose 50 times it has happened that it just closed and crashed back. So just see out of 50 how many times the volume was lower. We expected volume higher, but the volume was lower. Just see that. Are you in the stock markets but still guessing your next move? I am from Uncover Markets and we are bringing a complete solution for your stock market needs. Whether your portfolio is of 1 to 2 lakhs or 50 crore, we show you practical ways to enhance returns and protect your capital. You can take short, quick learnings you apply on the same day. Or let us handhold you through long-term programs like Elliott Waves and advanced derivatives to secure your portfolio and generate alpha. And if you enjoy fast-paced option buyings, we have got you covered there too. So join Uncover Markets and rise in the markets. Thank you. And those things will help you integrate different kind of indicators into your assessment. And that's how you do the backtesting, and that's how you do the failure statistics. You identify the failure rate. And very important aspect is when you are identifying that you are getting a correct move or you are getting a wrong move, then see the percentage of the move as well. Suppose in the previous example, 80% of the times it was the correct move, 40% of the times the move failed. But now see, in 80% of the times, what is the average percentage it has given you as the return? So suppose average percentage it has given you a return of 25%, and for the failure one, maybe average percentage of downside was 10%. Then you see you have a big win-win situation. And apart from that, we mentioned earlier that you should set up your stop loss maybe 1%, 2%, or maybe 4 5% down the levels at which you have purchased based on your risk appetite and risk tolerance, right? So when market is having a correct assessment, your assessment fits well with the market, you are getting 25% on every move. But when it is going down, then you are exiting because of the stop loss at 2%, maybe 3%. Now you see, when it is gaining, you are gaining really well. But when it is falling back, you are falling not much. So that means you are going to gain from the market anyhow, and it is not so tough from the market to make money. How much money you want to make? So it's the risk comes from that. Risk does not come from market itself. Market in the longer run, if you are just investing in it, definitely it will go up and you will be making the money. So that's how we do the analysis in the market, and that's it for this video. Thank you.